Jim Carroll, how are you, buddy?
Oh man.
It was stressful, huh? Did I mute you, Jim? Asking you to unmute.
Okay, I'm
All right,
muted.
there
Can you
we
hear me
go.
now?
Yeah, and a nice little NFT on yourself. What are you selling that for, buddy?
uh, Nothing. It's
All
a
right,
freebie.
all right. So I hear there's some changes in your professional life, in your career.
Yeah,
Like
I
about
gotta
that?
kind of. I've been advised to keep it quiet for the moment.
Okay,
But let's just say that after Labor Day, I'll be wearing a new jersey.
okay. So another trade. Another trade happening on the volatility side. Jim,
There we
I'm
go.
interested in this. We've had a little bounce in VIX, up to 17 or in that neighborhood. Where would the short vol guys begin to get squeezed?
Well, that's a good question. I've been waiting to get an answer to that myself.
Mm-hmm.
And can you see my screen now?
Yeah, we have your PowerPoint up there.
Okay.
Got it.
Yeah, this has been one of those years that has been frustrating again for people, either trying to hedge portfolios or to play the long side of volatility. And we've got the 2023 wall of worry. We've still got a war going on in Ukraine. Meh.
Yeah.
We had the regional banking crisis in March. Yeah. Bank of Japan. Collapsing credit in China.
Yeah. Everything.
We just keep shaking this stuff off, and the market bounces around a little bit. We take a little air out of it, and then we put the air back in. And as a result, you've been much better off on the short side of volatility most of the year than you have been trying to play the long side or even hedging. And I'll come back to that.
Okay. So
if you
really,
look,
the story hasn't changed. It's been this way for a long time. And it makes me think, though, that maybe recency bias about it working for so long, actually, people have even more confidence of being short vol. That maybe
I
it's a
think
very
there's,
big, heavily positioned, everyone's on the same side of the boat selling vol.
well, you know what happens when everybody's on the same side of the boat, and we'll find out at some point in time. But I think there have been a couple of factors involved.
ODTEs?
Well, zero DTEs is a controversial topic. There very clearly has been an increase in, what I'll refer to as the institutional use of shorter dated options. Dale, you understand options well enough. If you are a premium seller, right? If you're collecting premium, and once upon a time, you and I are old enough to remember when you could only do that once a month. And then you could do it once a week, and now you can do it every day. So if you're a seller of premium, a collector of premium, and you could do that every day, then you might be inclined to take advantage of that. So clearly that's been one factor driving the supply of volatility. The other thing driving the supply of volatility is the whole, and I use this term advisedly, structured product complex. There's an ever increasing number of strategies available to investors, including retail investors, that involve some package of options, and
for a hedge.
for a hedge or for, as an example, Innovator ETFs, who have been a huge player in this marketplace, recently launched an ETF that has zero downside. It basically is a 2-year product that offers, a portion of the upside in the S&P with a cap at zero on the downside. How do they do that? Well, they do it using option structures. And to the extent that investment advisors and retail people say, give me some of that, I'll take less than full upside in exchange for zero downside.
Yeah.
That means that that Innovator is out in the market on a regular basis,
Selling
buying
premium.
and selling premium, but yeah, in part selling premium, right? They're selling calls to buy puts.
Right.
And so I think there's been a large influx over the past few years of structured products in the options market, adding to the flows, adding to positioning, and in what has been, notwithstanding little blips here and there, a relatively benign environment. That flow is going to put pressure on implied volatility.
That flow also, the new innovations, which from innovation, also make the trade of short volatility even more crowded, don't you think?
Clearly. And the question is, how deep is the market? And the market's pretty deep. You're typically looking at SPX or SPY options that are being used to construct these products, and that is the deepest, of the option markets. So they're trying to be smart about what they're doing, but clearly it is adding to the supply of volatility in this market. It's sort of keeping downward pressure on implied volatility.
Okay.
Is that making it harder, to be on the long side? Sure, at least to a certain extent, that's making it harder.
Yeah.
And
it's crowded, Jim. I mean, I guess my whole point is it was crowded before, and with these new products, and actually one of our attendees is asking, is that an ETF, that Innovator fund, or do you have a symbol for that?
You don't? Try to remember what the symbol is. I'd have to go scrounge it up.
Anyway,
but
is it an ETF?
Yes, it is an ETF.
All right, so just spell Innovator, buddy, and you'll find it.
Okay. And so if you look at where VIX has been over the last 3.5 years, certainly from October of 2022, the trend has been down. We had a little spike in March, but the trend has been down. And in the grand scheme of things, I like to sort of zoom out and look at long-term averages. And if I say that a 1-year average of VIX above 20 is kind of a line in the sand, higher volatility regime and lower volatility regime, we're on the cusp of leaving what has been a higher volatility time period and moving back to what would arguably be a lower volatility time period. Obviously, something could cause volatility increase, but we're right on the cusp given the decline in volatility over the last year or so.
So that moving average comes in at 20, so that's going to be a big test should we get up there. Above that moving average.
It's for me, it's kind of a mile marker. It's something I pay attention to. It's not a bright line that things are going to be great if the red line goes back below 20. But certainly during those periods when that red line is above 20, we have seen and are likely to see increases in volatility.
Okay.
Looking at the year from the standpoint of the term structure using the CBOE volatility indices, the high was on March 13th, in the aftermath of Silicon Valley
SVB.
Bank collapsing, right?
Yeah.
But the year-to-date average, is we are right now pretty much in line with the year-to-date average. And with 9-day and 30-day VIX both below 20, 3-month VIX below 20 right now. So, we're in a relatively calm state. Remember that a 17 VIX, if you use the rule of 16, implies that the volatility market thinks we could see SPX daily moves of about 1%. And we'll come back to that. But, so if people think that volatility might be too low or too high, the current state of volatility is saying we could expect to see plus or minus 1% moves on a daily basis in the S&P, which has not been what we're seeing. We've been seeing lower moves, and I'll come to that. High low for VIX over the years, you can see that again, the average for this year is a drop and the range is relatively narrow. Volatility of volatility, the average has been dropping and the range has been narrowing. Looking at the VIX futures, and what I call VX30 is a constant maturity using the front 2 months and trying to pin, a 30-day picture of what the VIX futures are telling us. And again, from last year, we've seen the average drop, we've seen the range tighten. So the market is saying things are okay, things are less volatile. In terms of how the VIX is responding, the story in 2022 was that, the VIX was just not responsive. It was broken, quote unquote.
Right.
And, whether that's true or not, we are continuing to see a relatively muted response. So, this is normalized to a 1% down or up move in SPX and the point change in VIX, since it is a percentage to begin with.
It's been cut in half from 2020.
Yeah. So, it's from 2021.
Okay, yeah, all right, yeah.
The aftermath, 2020, you would think, but,
yeah, 2021. Yeah, the VIX never got over 38 during that whole 30% to 20% decline. Yeah.
Right. So the responsiveness of implied vol to moves in SPX, it does move, but the range is relatively narrow, which goes back to, the idea that the volatility is well supplied.
Okay.
Now, the story is realized volatility. The S&P has, just not had a lot of realized volatility. The range this year is way down from last year. The average is down from last year. It looks more like 2021. And, if there isn't a lot of realized volatility in the S&P, it's hard for implied volatility to go anywhere.
Mm-hmm.
And you can see that, visually on this one, as the S&P has climbed this year. The green line is 21-day realized volatility. And you can see that it has just collapsed. And the spread between realized and implied, whether you measure that with VIX or VIX futures, has widened. So you could argue that based on where realized volatility is, VIX and the VIX futures are too high, that they should probably come down even more. So there's still a meaningful premium, and that meaningful premium, for the intrepid investor suggests that, if realized is going to stay where it is, then I should be short volatility, not a recommendation. But that's what this would suggest to you, is that even if you think that volatility is lower than it should be, there's a case to be made that it can go even lower. Now, obviously, if the S&P, if there's some catalyst that causes the S&P to trade off hard and realize spikes higher, then maybe that premium's justified. But this is one of the reasons that there has been, a supply of volatility, people shorting vol.
Okay. Yeah.
Another way to look at that realized volatility is to say, okay, how often has the S&P moved plus or minus 2% in a day? And the answer this year is twice.
Wow.
So
and we're in August, so I mean, we've already had a good sample for this year, twice.
Right. Well,
That's
August
amazing.
and September, and even October, can show some volatility. So we may yet, get an increase in this. But, again, even with all of the stuff that has happened this year, we just haven't seen big daily moves in the S&P.
Yeah. Okay.
The last slide I've got, and I'm happy to, answer any questions if anybody in the audience has any. I went and looked, the recent high in the S&P was on July 31st.
Okay.
And, through yesterday's close, it's down about 4%. So if you just take two of the common ways that people might hedge, right? One's buying puts and one is buying VIX calls. The CBOE put, right, which is S&P exposure with rolling 5% out of the money puts. And the VXTH is the same idea, except you're owning the S&P and buying VIX calls. You can see that, neither one of those has done you any good in this decline by the S&P. Because the decline, this is 2022 all over again. The decline has been so kind of steady and unvolatile that puts haven't paid off and VIX calls haven't paid off. So you've paid for those pieces of protection.
Well, now we understand. Yeah, now we understand why people say this, that hedging is just a waste of money.
They
feel
you
that
talked,
way.
Yeah, no, absolutely. And what you talked about, short vol being a crowded trade. I would argue, and I would agree with that for a host of reasons. Maybe not as crowded as it was in January of 2018, but there's a lot of volatility supply from people who are selling it for one reason or another. The flip side of that is that long vol is a very uncrowded trade at the present time, because hedges just haven't been paying.
Yeah, people don't want to waste their money. Why buy fire insurance if there's never a fire?
There's, so I guess there's never going to be a fire, but think about it. If you're an investment advisor, if you've got, clients who are looking at their portfolios and you've looked at the wall of worry and said, I want to have a hedge in here. And then your client opens their account statement and that hedge looks like, a
hit.
a hit. Yes, indeed.
Yeah.
It is taking away value. You're under pressure not to make that go away.
Yeah.
And if you're an institution, if you've got a committee that you got to report to, and they say, what the hell is this thing that's bleeding in our portfolio? There might be some inclination to take it off.
The whole market's unhedged, and short volatility by is the view I've got. They're unhedged, which isn't great, and they're short volatility, and they've been picking up silver dollars off the sidewalk for years now. Just when and if a steamroller comes, and I know you had meh after China. I would say meh so far.
I would be right there with you. One thing
banks meh, I say so far.
Right.
Anyway.
we're gonna see what happens with China. We're gonna see what happens with banks. We're gonna hear what Powell has to say this week.
What do you think is bent is going to be biased to sound more hawkish, or is he going to give the market hope of a pause?
Well, that's a really good question. I think he's going to try to walk a fine line, splitting those two, because if in fact they're data dependent, then what the market seems to be saying is we're going to be higher for longer.
Yeah.
The S&P TLT has been terrible.
That's been your hedge.
Yeah, well, it hasn't worked very well, has it?
Well, I mean, being short bonds.
Yeah. Oh, short bonds. Yes.
Yeah, that's been your hedge.
Short bonds has been a good hedge.
Yeah.
Being having bonds in if you're hanging on to that 60-40 portfolio, this is feeling like 2022 all over.
Yeah, and how could the banking situation be any better when it was about duration, and we're about to, we're challenging the October lows in TLT.
Yeah, look, I think that's exactly right. I think, you've got a bunch of banks who were given a reprieve, but still have, significant mismatches on their balance sheets.
Yeah.
And that may come home to roost. One of the things that I watch every day, literally every day, two measures of the credit markets. One is just, spreads and yields. And obviously, if you're a high yield borrower and you need to finance something right now, you're going to pay a lot more than you did the last time you went to market. And oh, by the way, in the deal financing business anyway, the commercial banks have left the building. So if you want to finance an acquisition, as an example, and I have a lot of friends and clients in that deal business, you're dealing with vultures to get financing done. And spreads still look reasonably okay. But the other thing I monitor is, and it's kind of out there. It's not something that too many people watch, and I have to credit Tom McClellan for showing me where the data is advance and declines in the bond market. The data exists for high yield and investment grade to see literally, what the advancers and decliners are on a daily basis. And we've seen a lot more decliners than we have advancers recently. So even though spreads are holding up,
there's pressure.
Bond guys seem to be lightening up.
Okay.
And if that starts to reflect itself in spreads, hang on tight.
Well, Jim, I want to thank you again for, really a great presentation on, what's happening and how people continue to make money on this theme. And I wish you and the whole team lots of good fortune on your change after Labor Day. And we'll be talking in December. And I hope you have a great transition. It's smooth and that you take off like a mushroom.
Coach, I forgot, you're in Southern California, yes?
Yeah.
How was the hurricane?
It was wet. Not a lot of hurricane force winds where I was at, but about four inches of rain.
Yeah, wow.
In
Wow.
9 hours. Yeah.
Yeah,
So
wow.
anyway, Jim, not much can keep me down. No hurricanes or
Yep.
hits in the market, and even once in my life, cancer. So, I'm still standing after all of this, and I'm ready I think we're in the eye of the hurricane right now, Jim, in financial.
We may well be, and I know you're ready for it.
I am, buddy, and I really great catching up with you, Jim, and I'm a fan, and I know wherever you go, you're going to add value.
Peace to you, brother.
All right. Jim Carroll, everyone, you could still follow him at VIXologist. You want to learn about all the intricacies of Vol. He's your doctor. Thank you, Jim.
All right. Thanks, Dale.
All right, buddy.
Bye.
Okay, everyone, you could join the team in 11 minutes on the morning edge. Good hunting the rest of the day. Don't just count your pips, count your blessings. See everyone tomorrow. Thanks for all your well wishes during the storm. Glad to be up and running. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.